The housing market is shifting and millions of Americans could get trapped. Take a look. For the first time in a decade, housing ownership in the United States officially began falling in 2025. This means more sellers are starting to feel stuck, buyers are struggling to afford a home, and the government is concerned that the system is starting to crack. And to help fix this problem, the Trump administration recently proposed a 50-year mortgage as a way to make housing more affordable for millions of Americans. This idea of lower mortgage payments might sound good at first, but there's a hidden trap here that I want you to be aware of, so let's break it all down. In September 2025, we got the news that home ownership in the United States is falling for the first time in about a decade. That was when a lot of people got scared that maybe the housing market is on the verge of a downturn because people can't afford to buy a house anymore. And this is where the Trump administration has discussed a number of different things to help fix the affordability crisis and make housing a little bit more affordable. President Trump has talked about declaring a national emergency in the housing market. That way the president can do more things without approval of Congress. President Trump has been pushing construction companies and developers to build more houses and develop more housing as a way to create more housing in the United States. And now, most recently, President Trump has proposed a 50-year mortgage to make mortgage payments cheaper for more people to go out and buy a house. But let me help diagram what exactly is going on, because in 2020, if you went out and bought this house, you might have paid $355,000 for it. You could go out and get a 3.5% mortgage, which meant your monthly mortgage payment would be about $1,250 a month, assuming you put 20% down. Well, by 2025, things changed quite a bit. If you wanted to buy that exact same house in 2025, now it's going to cost you about $500,000 because it's now 40% more expensive to buy the exact same house. You also can't get a 3.5% mortgage. You might be getting a 6.5% mortgage. So if you got the same 30-year mortgage with 20% down here, now your monthly mortgage payment is going to be about $2,500 a month, which is an increase of around 100% on your monthly payment, while over these same 5 years, we have seen wages, the median wage in the United States, rise by around 22%, which means your income has gone up, but it has not gone up to keep up with the growth in housing prices, and it definitely has not kept up with the growth in monthly cost of ownership of the house. Not to mention that now when your house is more expensive, your property taxes are more expensive too, and your property insurance is more expensive because you're paying taxes and insuring a more valuable property. So the cost of ownership has gone up significantly faster than incomes. And this is where there are really three ways to make housing more affordable, and then let's tie that into the new Trump proposals. The first way to see more affordable housing is just to have cheaper houses, which could, in theory, mean that this house would now not be worth $500,000, it would be worth $450,000. Still quite a bit of an improvement from 2020, but not as high as we were in 2025. The problem with that is if home values were to go down by just 10%, well, that would mean that a lot of people now are suddenly underwater on their houses. They have negative equity. And then the concern would be if people don't have equity in their houses, we would see a rise of foreclosures in the United States. And that's what we're already starting to see happen right now in the United States, is foreclosures are starting to rise because people didn't have enough equity in their houses, or they couldn't afford the monthly payments on their houses. And this is where the concerns about a housing bubble really start to rise, where, oh my God, a lot of people have houses who shouldn't afford them. And what happens if housing prices fall? People can't afford it. That's the concern, and that's the negative side of housing prices falling. And we have seen the impacts of that because when housing prices fell during the 2008 great financial crisis, it created a huge financial meltdown, which almost destroyed our entire financial system. So yes, cheaper houses will make housing more affordable, but there's a cost to that. Option number two is a cheaper mortgage. Now, there's two ways to get a cheaper mortgage. You can get a lower interest rate, but the government can't control that. And the other way is the government can say, instead of having a 30-year mortgage, how about a 50-year mortgage as a way to lower mortgage rates? Now, I'm going to talk about that in just a second, but the idea here is now your mortgage payment goes down from $2,500 a month to $2,250 a month. That way it is more affordable for you to buy a house. But there's a couple things that I want you to be aware of. In this scenario right here, when you get a 30-year mortgage, you're going to end up paying right around $900,000 to purchase this house. That's $500,000 to purchase the house, plus $400,000 in interest payments over the course of this 30-year mortgage. If you could go out and get a 50-year mortgage, and for the purposes of this example, let's just assume that you get the same 6.5% mortgage rate on this 50-year mortgage. Now, your mortgage payments are not going to be $2,500 a month. They're going to be $2,250 a month. So you're going to save $250 every single month. And the idea is now you can go out and invest this difference. But I want you to also remember this. Now, when you have this 50-year mortgage, you're not going to pay $900,000 to buy the house. You're not going to pay $1 million to buy the house. You're not going to pay $1.1 million to buy the house or $1.2 million. You're going to end up paying $1.3 million, actually $1.35 million to purchase the house, which means you paid $500,000 for the house plus an additional $850,000 in interest to purchase the house, because these mortgages are amortized, meaning they're front-loaded, meaning in the beginning of your mortgage, almost all of your mortgage payment is interest. Very little is actually buying principal or equity in the house. And so now when you extend the mortgage to 50 years, you're going to have a lot more money going in interest, and that money is going to be going into the banker's pocket during the beginning part of that mortgage. So when you go out and get a 50-year mortgage, it sounds nice because you get a lower mortgage payment, but now many times you're going to be in debt for the rest of your life, and that makes the bankers richer. Now, the argument can be made that, what if you invest the difference? You can take the $250 and invest it into the markets every single week, every single month, and now you can build wealth in the markets, which is a great idea. The problem is most people won't. It's the same reason why people want the 30-year mortgage instead of the 15-year mortgage, because well, we extend ourselves to the extent that we can purchase. That is the American way. I'm not saying it's right. I'm just telling you what happens. People buy as big as they can, and we think that this house is an investment, and now we extend, and now you have no money to invest. That is the problem. Now, for those of you that are investors or want to become investors, I do have a free investing masterclass where I walk you through how you get started as an investor and find hidden investment opportunities before everybody else. I'll even share the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It's completely free, and as a bonus, we're also going to give you access to Market Briefs, which is my newsletter for investors, completely complimentary. So if you want to get the Investing Masterclass and Market Briefs all for free, all you have to do is register, and I have the link for you down in the description below. So we know that lower mortgage rates can make you feel good in the beginning, but we know that ultimately this is going to make banks a whole lot more richer, because banks are going to get a windfall because they get to keep you in debt for the rest of your life, and now you get to keep working to pay them a whole lot more money in interest compared to the 30-year mortgage. But let's focus on the housing market for a second. If mortgages are cheaper because there's a 50-year mortgage or because mortgage rates were to fall and now it is more affordable to go out and pay this mortgage payment, what does that mean for the housing market? Well, think of it this way. If mortgage rates fell to 4% tomorrow, what do you think is going to happen? Probably a lot of people are going to want to go out and take advantage of these lower mortgage rates. They're going to want to take advantage of the cheaper cost to own a home month over month. So now if we have a new influx of buyers into the housing market without a new influx of supply, that could potentially create now bidding wars in the housing market, which could potentially lead to higher prices in the housing market. So we know that cheaper houses can help make housing more affordable, but there's a consequence that could lead to an economic downturn. We know that cheaper mortgages, whether it's a 50-year mortgage or a 3.5% mortgage rate, can lead to cheaper mortgage payments, but the consequence to that is that could lead to more people wanting to buy a house, which could then inflate the housing market again, because that could lead to more bidding wars and higher housing prices again. Option number 3 is increasing wages while housing prices and mortgage payments stay the same. And this could actually make housing more affordable, but this is really not in the hands of the government. It's in the hands of the growth of the actual economy, because we know that, well, wages have gone up by 22% over the last 5 years, while housing prices have gone up by 40%, while the monthly cost of homeownership has gone up by 100%, actually more than that, because we haven't factored in the higher property taxes and the higher insurance. So when wages haven't kept up, it makes it much more difficult for people to actually buy a house. But if housing costs stay the same, but wages go up, well, now all of a sudden housing can become more affordable. But again, the government can't control that. In fact, what's happened in our economy is we've become very reliant on free money from the government, and when we can become reliant on this money from the government, it becomes harder for the real economy to grow by itself without that additional help from the government. So that's where things start to become a problem, because what we've seen over the last 5 years is that incomes haven't kept up with inflation, and if incomes don't keep up with inflation, it's harder to see that real wage growth. That's where it is a real conundrum on how do you actually fix the housing market and make housing more affordable, because everything has a consequence and nothing moves in a vacuum. You can't just have cheaper mortgages without impacting demand or supply of houses, which can impact housing prices. And we can't just suddenly change wages and then affect housing to be more affordable. Things move in this interconnected system in our economy, and this is where the government is trying to do multiple things, whether it's building more houses, whether it's lower mortgage rates, whether it's a 50-year mortgage, whether it's new housing policies to try to make housing more affordable. But at the end of the day, the thing that I want you to understand is that when it comes time to you to buy a house, it's more important for you not to look at economic factors and more important for you to look at your personal finance factors. What I mean by that is your house that you live in is not an asset. It is a liability. This is how wealthy people look at their house. Now, I understand everybody believes that the house that I live in is the biggest investment in the world. I get it. I used to be a licensed realtor many years ago. And the big system, the big sale is you are selling the biggest and best investment that anybody's ever going to buy. And when I'm selling you this investment, your house, it's easier to get you to buy bigger. It's easier to get you to buy nicer. But also remember, your realtor is paid on commission. Your banker is paid on commission. The bigger you buy, the more they make. Now, not every realtor and every banker is a bad person, but you just have to understand the incentives in the game. For you to become wealthy, you need investments. Your house only makes money if you sell it for a profit. If you don't sell it for a profit, it doesn't make you money, and when you sell it, you don't have the house anymore. If you really want to build wealth, the way wealthy people think about it is I want to own an asset that I buy for the purpose of making money. That could be stocks, it could be rental properties, it could be startups, it could be gold, it could be crypto, it could be a whole lot of things. But these are things that are buying for the sole purpose of making money. So when it comes to your house, think of it from a liability perspective. Can you afford the house? Can you afford the down payment? Can you afford the monthly payment? Can you afford the move-in cost? By move-in cost, I mean the cost to hire movers, the cost to do whatever upgrades you want to do, the cost to finish up the patio, the cost to get the new furniture. That's the move-in cost. And if you can afford the down payment, having at least 20% down, if you can comfortably afford the mortgage payment and continue to invest your money every single month, and you can afford the move-in cost, well, now you can afford to own a house. Now, that's going to be hard, but if you want to actually afford a house, that's the way to do it. You don't have to own a house to build wealth. There's many ways to do that. You need to own investments to build wealth. And your house is not the only investment opportunity out there. If you really want to become wealthy, you have to do it outside of your house because, well, even if you pay off your house, you still have expenses to pay. You still got to pay your property taxes. You still got to pay your insurance. You got to pay for the maintenance. You got to pay for the utilities. And if the home goes up in value, your property taxes just got more expensive and your insurance just got more expensive. So keep that in mind. Your house is a liability. Buy a house that you can afford and understand the longer the mortgage, the more interest you got to pay. My goal for you is to stop paying the bank. That way you can pay yourself and make yourself wealthy before you make everybody else rich. It's not very popular opinion, but if you really want to become wealthy, you need to keep that money for yourself instead of just giving it to your banker. So hopefully that helps you understand what's going on in the housing market. That way you can make smarter decisions with your money. Again, if you are an investor or want to become an investor, I have a free investing masterclass for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. Thank you. It is getting harder than ever for the average person to get a job and build wealth because traditional entry-level skills are now being automated by AI. But this is the silver lining, because for those of you that are go-getters that want to go the extra mile, this shift is going to create more millionaires than ever before. And yes, the things that I'm about to show you will apply whether you work a job or run a business.